Christmas and New Year period was hardly peaceful from a financial market point of view. Stock and bond markets proved volatile, thanks in part to some mixed macroeconomic data from the US and China, and also Apple's profit warning. Now, Apple may have got the US fourth quarter reporting season off to a bit of a bad start, but we'll be able to find out a little bit more about the health of corporate America in the coming week, when the results season starts to hit top gear. Around 30 of the S&P 500 index's members are due to report their quarterly results, and most of them are financial stocks, including megabank Citigroup on the 14th, JP Morgan Chase and Wells Fargo on Tuesday the 15th, Bank of America and Goldman Sachs on the 16th, and Morgan Stanley on the 17th. Investors will be looking for strong numbers here, as the bank sector was a terrible stock market performer the world over in 2018. And if there's one sector that we'd really all like to know is healthy, some 10 years after the Great Financial Crisis, then surely it is the banks. This chart shows the US KBW Banks Index on the left-hand axis and the S&P Global 1200 Banks Index on the right-hand axis over the last 12 months. It's not pretty, is it? Also watch out for Netflix on Thursday the 17th. Its shares never really recovered from missing second quarter subscriber growth numbers, even if the third quarter figure was better than expected, as investors began to focus on its ongoing cash outflows, substantial debts and content spending plans. As one of those 5 FANG stocks which did so much to take stock markets higher in 2017 and 2018, it could be helpful for bullish investors were Netflix to provide a good set of results and forge some fresh positive share price momentum. In the second chart, we can see Netflix's share price on the left-hand axis and the NYSE FANG Plus index on the right. Not that pretty either. Now, closer to home, the volume of corporate commentary will also pick up in the coming week, with a good number of FTSE 100 and FTSE 250 firms scheduled to publish results or trading updates. They include recruitment specialist Page Group on Monday the 14th of January, doorstep lender Provident Financial and another recruiter Hayes on the 15th, Tullow Oil on the 16th, and then on the 17th we get Primark owner Associated British Foods, Experian, snack seller SSP Group and Whitbread. But for all of those, the company that looks most capable of causing a fuss in the coming week is FTSE 100 house builder Persimmon, which is due to release a full year trading update on Tuesday the 15th of January. Now, the shares took a bit of a drubbing in the second half of 2018, although they weren't on their own there, amid worries that UK house prices perhaps peaked and that weak consumer confidence, lofty house prices and the Bank of England's second interest rate increase of this cycle could all start to weigh on demand for mortgages and housing, and therefore house prices. Now, the government's done its bit by extending the Help to Buy scheme out to 2023, and Persimmon will doubtless also be looking to move on from the outcry of a former boss Jeff Fairbairn's pay packet. He stepped down on the 31st of December last year to be replaced on an interim basis by Group Managing Director David Jenkinson. Now, rather than trying to justify the structure of its bonus schemes, Persimmon will no doubt want to focus on fundamentals, and analysts will be looking towards 5 different headline numbers as part of this trading statement. The first, well, that's going to be volumes. Persimmon completed 16,043 homes in 2017, still just below the pre-financial crisis peak of 16,701 that it reached in 2006. The second number, well, that's average selling prices, which reached a record £213,000 in 2017. That compares to the prior peak of £190,000 in 2007. That figure is still, however, the lowest of the major quoted house builders, thanks to York headquartered Persimmon's geographic focus, with 52% of its plots based in the north and 48% in the south. We can see the trend in volume, completions and prices here. The third key number is the order book. Persimmon ended 2017 with an order book just shy of £1.4 billion. And then next comes pre-tax profits. Management may give a steer on the year's outcome relative to the analyst consensus forecast, which calls for an 11% increase in pre-tax profit to just under £1.1 billion. We can see the trend over the last decade and analyst forecasts for the next 2 years here. Finally, check out the net cash position. At the end of its last financial year, Persimmon had a net cash pile of some £1.3 billion. Now, this is important because it's this liquidity which helps to fund the purchase of new plots of land and drive future profits, but also dividend payments to shareholders. Remember, Persimmon has a plan to return £13 a share in cash to investors between 2013 and 2021. It's already handed over £7.20 a share in dividends, and per share payments of 235p, 235p and 110p are due in 2019, 2020 and 2021 respectively. Now, management said it will update the market on that plan alongside its annual results in late February, but if the payout for this year is confirmed at 235p, well, that equates to a dividend yield of 11.7%, the second highest in the FTSE 100 behind only fellow builder Taylor Wimpey, according to analyst consensus forecasts. Thank you for watching, and I look forward to seeing you next time.